Let's understand what's happening with NIO stock. It's quite a precarious situation. As we can see, if we break the $4.90 level, there's a significant potential for further decline. We need to consider volatility and options market to get a clearer picture of where this stock might be headed. Let's start from the beginning. The stock has been on a downward trend for the past week, dropping nearly 15%. This is quite serious. Let's analyze the volatility and the options market to see where it might be heading. Remember, this is an automotive manufacturer, a Chinese company, so there are risks associated with the listing of this company that we must consider. Looking at volatility, it currently ranges from 70% to 80% at different strike. We observed a significant volatility crush after the earnings report. Once it passed, volatility stabilized. This will help us craft a sensible strategy and position ourselves accordingly. To make money, let's examine the volatility smile. Currently, the smile is skewed towards the downside, indicating a preference for puts. There's a significant increase in volatility on the downside compared to the upside. As we can see, the smile curve is flat, suggesting that traders are hedging against downward movements by buying options, thus making options more expensive. There is increasing demand for them. Let's look at historical and implied volatility. Historical volatility is represented by the gray line, while implied volatility is the white line. Currently, volatility is higher than its historical levels. From this, we can deduce and formulate a good strategy for when volatility returns to its normal levels. This always happens, so sooner or later volatility will decrease, allowing us to build a strategy around decreasing volatility. Let's examine the distribution of open interest in options. A significant volume is concentrated at the $10 level for call. For puts, the main volume is concentrated at the $5 level. The strategy is evenly distributed, meaning there is no weekly skew. Certainly a solid portion is expiring next week, but these are acceptable values. So I would advise you to focus on these walls, meaning the volume wall at $10 and the volume wall at $5. As we can see, the $5 wall volume worked well, but now at the moment, if the stock is indeed about to decline, then all these options will start to generate profit and the movement may accelerate. Returning to the new stock, let me reiterate my philosophy that I don't know how the price will move. I have no idea where the stock will go. The most important thing is sound position management, as I always say. However, considering the volatility, I can say that if we experience a breakthrough at this level, then the potential for a drop could be significant, down to $4, which is quite substantial. Let's look at the chain of options and try to devise some interesting strategy for this stock. I've come up with a small strategy. As we can see, if the price remains at the $4.6, we don't lose anything if it drops to $7.50 or $2.50. Yes, we incur minor losses, but again, this strategy is aimed at sharp price changes in either direction. As we can see, if the price sharply rises or falls, we will start making money on it. However, I absolutely do not recommend opening this strategy casually because it requires serious knowledge and understanding of the options market. This strategy needs to be managed, meaning selling closer options, buying further options, possibly buying additional shares, not just buying, but buying according to delta-neutral hedging. This dynamic strategy is quite complex. It requires fundamental understanding of the options market to profit from it effectively. I'm demonstrating this strategy solely to illustrate how I manage my portfolio. I build my strategy so that no matter which way the price moves, I would profit, albeit with some losses. These losses can be hedged or mitigated through options, and that's exactly how I operate. If the price goes down, I'll profit. If the price goes up, I'll still profit. That's the most sound strategy in my view, but again, pay attention to how you buy this stock. If you're buying for the long term for 10, 20, or 30 years, then whether you buy it at $5 or $4 doesn't matter much if you're aiming for $50 to $60. Here, the profit potential is very high, around 1,000%. If you're day trading, of course, the situation is different. But again, I want to remind you of the risks because this is a Chinese company. If something worsens, the situation deteriorates, it could certainly harm this company. You shouldn't overlook this aspect when considering your investments. The stock, of course, is promising, but at the moment I want to remind you that it's unprofitable. And seriously so. In fact, we have plenty of stocks that are profitable, that bring in money, so why focus and stop at such risky stocks? I'm not entirely clear. I don't have this stock in my portfolio, but of course I'm interested in watching it, seeing what happens. But again, I want to say that the best strategy is prudent position management. If you learn to do this, it won't matter where the stock goes, whether it goes up or down. Investments will actually turn into making money for you. I also advise you to look at my forecast. There I also analyzed in detail the strategies, what could happen with it. What is its growth potential? What is the potential for decline? The growth potential, of course, is very high. The question is when it will happen. It's not clear. Good luck to everyone.